Okay, so this video lecture is for our module 4. So this is entitled Cost Volume Profit or CVP Analysis. Okay, for the learning outcome, so at the end of our module 4, so you will be able to understand and be familiarized with the concept of break-even point, margin of safety, and degree of operating leverage, and as well as to compute also this financial formula or ratios. Okay, so for the content, so we will have, of course, to discuss about the break-even point. This is in units. The second will be in peso or in terms of the level of revenues, margin of safety, and the degree of operating leverage. So to start with, let us first introduce or discuss what does cost volume profit or CVP analysis is all about. Okay, so basically when we see CVP analysis, this is one of the methods that is used also in cost accounting or management accounting that looks into the impact of the varying levels of our costs and its relationship also with the level of volume of units that an entity will produce or will be producing, and also what is the effect of the cost, the level of volume, or the relationship with the profit, okay, that will be earned by the entity. So basically, your cost of production, the number of units that is produced and even sold, will have an impact or will have an effect on the level or the amount of the profit that an entity will be generating. So this is an important analysis or relationship that every entity should understand. Okay, so the purpose of this also is to minimize as much as possible the costs that is incurred and to maximize their output as well as their sales or profit. So the cost volume profit analysis, this is also commonly known as your break-even analysis. Okay, so as we go along, you will know what break-even means. Okay, so this also looks to determine the break-even point for the different sales volume, cost structures, which can be useful for managers in making their short-term economic decisions. So, of course, the target of this management personnel is to control as much as possible the costs that were incurred to maximize their output and also to generate more sales and greater profits. So the cost volume profit or CVP analysis will make several, or we will use several assumptions here. So this may include the sales price, the fixed costs, the variable cost per unit. Okay, of course, these are constant. Variable cost per unit are constant. Okay, so as what you have learned in our classification of cost, but when it comes to its total, it varies. Okay, so running this analysis will involve using several equations also for the price, cost, and other variables in our formula. So others also or other entity may also graph them or plot them in a graph or economic graph to visualize how this relationship are being presented or reflected to be able to understand better their relationship. Okay, so what does CVP analysis tells us? So the contribution margin. Okay, so basically CM or contribution margin, this is the result of deducting from your sales our variable cost, meaning gross sales or revenue minus your variable costs. This is our contribution margin. Okay, so this is another way of presenting or computing an income, okay, using for internal use. Okay, so here when you present it under the contribution margin format, so we will classify the cost as fixed and variable. As when compared to our usual income statement preparation, what we classify is according to their nature, or the costs are, classified according to their nature or function. Whereas under the contribution margin format, we will classify the cost as fixed and variable. So this is what contribution margin is. Okay, again, this is the difference between your sales or revenue minus variable cost. So that is our contribution margin. So the contribution margin, this is normally used in determining our break-even point, okay, in terms of sales. So here, later on, as we go along with our module, you will understand we have a separate section for this one. But for introduction purposes, we have here, okay, in this paragraph. So basically, we will divide the total fixed cost by the CM ratio, or contribution margin ratio. So the break-even point of sales in terms of peso or dollars may be calculated. So we have here an example. A company with 100,000 of fixed cost and they have contribution margin of 40% will earn, or should earn, revenue of 250,000 to break even. So basically, break even actually is, this is where your level of revenue is just equal to the amount, okay, of your cost that you incurred. So there, at break even point, you have no profit or you have no loss. Again, your revenue is just equal to your costs. That is at break even. So profit may be added to the fixed cost, okay, to perform our CVP analysis if an entity wants to, or desired, or have a target of outcome. So you can add the profit or desired profit in the formula. So for example, if in the previous illustration, or in the above example, the company wants or desired an accounting profit of 50,000. So the total sales revenue is found also by dividing 150, meaning this is the sum of our fixed cost of 100,000 plus the 50,000 desired income. Okay, so we will divide it by the contribution margin of 40%, contribution margin ratio of 40%. So here, in this example, the entity or the company will yield a required sales revenue of 375, meaning they have to meet this 375,000 level of sales revenue for them to be able to have a desired profit of 50,000. Okay, so below 375, if for example they reach the level of revenue below 375, so meaning their profit will also be lower than 50,000. Okay. So CVP analysis is only reliable if our costs are fixed within a specified production level, so at relevant range. So all units produced are assumed to be sold here, and all fixed costs must be stable, okay, in a CVP analysis. Another assumption that we will use here is all changes in expenses occur because of the change in the activity or level. So your semi-variable expenses, they should be divided between fixed and variable. So you can divide or split this semi-variable or mixed cost using this technique, such as high-low method, scatter plot, or statistical regression. So these are the most common mathematical tool that is used to separate mixed cost into fixed and variable cost. Okay. So contribution margin and contribution margin ratio. So Basically, this is an important element in the computation of our break-even analysis. So you have to understand what does CM or contribution margin is and CM ratio. Okay, so CVP analysis, it is also mentions product contribution margin. So your contribution margin, as mentioned earlier, is the difference between our total sales and our total variable cost. So for a business to be able to generate profit, so the contribution margin must exceed their fixed cost. Okay, so the contribution margin may also be calculated per unit. Okay, so our contribution margin is simply the remainder after the unit variable cost is subtracted from the unit sales. This is in terms of units. But you can also solve your contribution margin in total. So that is total sales minus total variable cost. But if you want to determine the per unit contribution margin, so simply this is the difference also between the unit sales and or unit sales price minus the unit variable cost. Okay, so the contribution margin ratio, how do we determine this one? So your CM ratio, this is determined by dividing the contribution margin by our total sales. So this is how you compute your contribution margin ratio. This is simply the ratio of your contribution margin with your total sales. Okay, so those are for the cost volume profit analysis. So we will be discussing the computation of break-even point in the next video lecture.